All right, interest rates have been the big story in 2022, and mortgages, of course, are a part of that story. This headline caught my attention this morning. Rates hit over 7%, the highest in 20 years. Well, that sounds high on an absolute basis, but there's other ways that we can measure whether or not mortgage rates look cheap or expensive. That's what we're talking about. We're going to update where things stand on this key relationship that exists between mortgage rates and the 10-year government bond. Stick around. Now, this chart might look familiar if you've been following along with a couple of my other videos. Again, just to recap real briefly, there is a key relationship that exists between the 30-year mortgage and the 10-year U.S. government bond, or the 10-year Treasury. And there's some good reasons why there's this tight correlation, which you can see in the chart here, but it's beyond the scope of what I want to discuss. All you need to know is that this relationship exists. Now, what we care about is the difference between these two rates of interest. This is also known as the spread in the investment world. We can measure this spread over time, get an average, and see where we're at today for comparison. And that's what's going on in this bottom chart, if you will. So the long-term average, or the difference between these two lines, is typically, let's call it 1.7%. So in other words, what that means, if the 10-year U.S. government bond is at 4%, well, based on historical relationships, we would expect mortgage rates would be at 5.7 or 1.7% higher than the 10-year government bond. But obviously, rates are in the 7% range based on that Wall Street Journal article. So the spread is much higher than normal, or much higher than the long-term average, and you can see that in the data set. Now, this isn't terribly surprising that we've seen a big move in the spread this year. If you look back where we've seen these previous peaks, obviously in early 2020 when the pandemic hit, and also during the global financial crisis, these were periods of extreme financial turmoil. The markets were going crazy, and the markets are what ultimately set the rate of interest on mortgages. But it's also worth pointing out that whenever spreads hit these peaks, they didn't stay there for that long. They actually came down pretty darn quickly, and frankly, in both cases here, following the global financial crisis and following the onset of the pandemic, spreads actually went below the long-term average. My point is, if history is any guide, this spread that exists today, which suggests mortgages are very expensive on a relative basis, is likely to narrow. But I also should point out that that narrowing can happen one of two ways. Obviously, mortgage rates can come down. They need to come down about a full percentage point to get down to the average. Or Treasury yields could go up. Okay, but here's the other thing. Classically, whenever we're in the midst of an economic slowdown, interest rates decline, and you can see that in these gray shaded areas. These represent recessionary periods. And again, there's reasons why interest rates tend to decline during economic slowdowns. It's beyond the scope of what we need to discuss, but I just want to point this out because I think that's relevant in interpreting this information and goes in favor of the chances of interest rates declining. So look, I put this video together today because I'm reading these headlines. People are freaking out that rates are over 7 at 20-year highs. What am I going to do? And nonetheless, when you look at some of these things like spreads, they suggest that rates are higher than they should be. And there's other things we can look at. I'd have to do probably a whole video series on this. There's indications in the bond market that long-term yields are close to their peaks, and that has to do with the relationship between short-term interest rates and long-term interest rates. But I don't want to get too wonky here. I just think if I were personally in the mortgage market today, I would seriously be considering, I'd certainly look at 30-year fixed-rate mortgages, but I'd also seriously consider either no-cost mortgages or even adjustable rate mortgage, knowing that there's a fair chance that in the not-so-distant future, I'm probably going to be able to refinance at a lower rate. Again, it's no guarantee, but if we look at what's happened in history, that oftentimes can be a fair guide to the future. So anyway, I hope this was helpful today. One thing I want to be clear about, I'm not in the mortgage business. I just find this market stuff fascinating and just wanted to share this with others. So I hope it was helpful. Look, if it was, just give me a thumbs up. It lets me know you like the video, and I hope we'll see you on the next one.